I'm Matt Bouchard with NAREIT's REIT.com here in New York City for REITWeek 2015, NAREIT's Investor Forum. Joining me for this CEO Spotlight is Mark Zalatoris, President and CEO of Inland Real Estate Corporation. Mark, thanks so much for joining us.
Thank you for having me, Matt. Appreciate it.
Now, your company's benefited from high occupancy and rent increases lately. What do you view as the keys to generating that level of demand for space at your company sites?
Well, you know what they say in real estate, location, 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 right? So we feel we have market dominant presence in a couple key markets, particularly in the Midwest, Chicago and Minneapolis, and we've parlayed that into success in leasing and re-leasing space in those markets with strong retailers that want to continue to grow store count in those markets. So we've had for 16 quarters positive leasing spreads on new leases. We've always been positive on renewal rates. And our occupancy for the last 6 quarters has been 95%, or leased occupancy 95%, which is approaching basically full occupancy. And so realistically for us now, we have to work with the retailers to create space because we just don't have vacant space available. So we're very proactive on the asset management basis, looking at redeveloping spaces, moving tenants around, downsizing those that want to go smaller, so we can bring in new tenants in these bigger spaces. So it's an active asset management activity, and it's actually a lot of fun compared to having to react to bad economic times. These are good economic times for strong retailers that want to be in the markets we're in.
And at the end of the year, would you envision that your company will be a net seller or acquirer, and what factors are going to drive those decisions?
Well, we believe we'll be a net acquirer at the end of this year. We're active in acquiring for our joint venture partners. As a matter of fact, our most recent joint venture with the Dutch pension fund advisor PGGM, we just recently acquired, I think, the last property in the last week or so that fills that joint venture up. So we've acquired over $100 million worth of assets just this year, and it was a $900 million total portfolio goal, which we've achieved. And then on balance sheet for the rest of the year, we're probably going to be a net acquirer on balance sheet. We are recycling assets. We're selling smaller unanchored strips that we bought a number of years ago, and we're selling them at profits, and we're rolling those proceeds into newer, bigger, larger assets with we believe have greater growth profiles. So that, on balance, we'll end up being a net acquirer, we believe, at the end of the year, in both activities, both for the joint venture portfolio, which we just kind of wrapped up in the first half of the year, and then balance sheet for the second half.
And picking up on that concept of joint ventures, do you envision more sort of deals like that?
Well, PGGM was a great partner. We've reached our goal with that. Given the size of our overall company, I think this portfolio is at its maximum size. We don't have a current intention to do another joint venture, but until we can start buying back the interest that our partner has starting next year, which was our stated intention. And at some point, if it makes sense, and PGGM is a great partner, they have continued interest, we might work with them in the near future. But at this point, one sizable joint venture is probably enough.
Mark, thank you so much for joining us.
Thank you for having me. I appreciate it.
For more on this and other REIT news and analysis, be sure to visit REIT.com.